$37 trillion. That's what the US government owes right now. $280,000 per household. And here's the thing, nobody wants to say out loud. It's never getting paid back. Not through taxes, not through spending cuts, not through some magical economic boom. The math stopped working somewhere around 2008, and we've just been pretending ever since. China's backing away from buying our bonds. Japan's quietly diversifying. The Saudis are talking to Beijing about oil deals in yuan. And meanwhile, your financial advisor is still telling you to keep 6 months of cash in a savings account earning 1%, while real inflation, not the government number, is running at what, 7%? 8%? So here's my question. If the people running the system don't believe in the currency anymore, why are you still holding all your wealth in it? I'm going to walk you through exactly what's happening right now in early 2026, why this is the biggest wealth transfer in our lifetimes, and how I'm personally positioning my portfolio. Not theory, not some guru nonsense. This is what I'm actually doing with multiple hundreds of thousands of dollars I've got invested. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Look, I spent 10 years running my own business, sitting in rooms with accountants and fiscal lawyers who know how money actually moves. And they taught me something critical. The system isn't broken. It's working exactly as designed. You just weren't told what the design was. Think of it like this. Imagine you're playing musical chairs, but the guy running the music also controls how many chairs get removed each round. That's the currency game we're in. The Federal Reserve controls the music. The government controls the chairs. And they've decided there aren't going to be enough chairs for everyone holding cash. So you better find yourself an asset to sit on before the music stops. Here's where this gets weird. The $37 trillion in debt, that's just the official number. The actual obligations, when you include Social Security, Medicare, all the promises made to government workers, it's somewhere north of $150 trillion. I read the Congressional Budget Office reports. This is their math, not mine. There is no tax rate, no economic growth scenario, no austerity plan that makes those numbers work. None. So they're doing what every empire does when the debt gets too big. They're going to inflate it away. There's this story from ancient Rome I think about a lot. 3rd century AD, the empires got massive debts from constant wars. So Emperor Caracalla, smart guy, comes up with a plan. He takes the silver coins, melts them down, mixes in cheap metals, stamps them with the same face value. Boom! He just paid his debts with coins worth half as much. The soldiers got paid, the contractors got paid, everybody's happy, except the coins buy half as much bread at the market. That's not a currency collapse. That's a wealth transfer from savers to the government. We're doing the exact same thing, just with more steps and better PR. Now you might be thinking, okay, but we're not Rome. We've got the Federal Reserve. We've got checks and balances. Here's what actually happened in the last few months. The Commerce Secretary, not some random politician, the Commerce Secretary publicly attacked Jerome Powell and the Fed, demanding they cut interest rates. That's not normal. The Fed is supposed to be independent, supposed to make decisions based on data, not political pressure. But Trump's been very clear. The next Fed chair will be someone who does what they're told. And what they're told to do is cut rates, keep borrowing cheap, keep the music playing. They already cut rates in late 2025, and they're going to cut more in 2026, even though inflation is still running hot. Why? Because the system needs cheap debt to function. The government's spending $2 trillion more per year than it collects in taxes. Where's that money coming from? Not from some surplus we saved up. It's borrowed. And if interest rates go up, the interest payments alone become the biggest line item in the federal budget. Game over. So they're trapped. They have to keep rates low, which means they have to keep printing money, which means inflation stays high, which means your cash loses value. This is the design. This is the plan. And once you see it, you can't unsee it. But here's where it gets really interesting. How are they actually funding this? Because like I said, China's out. Japan's diversifying. Who's buying all these bonds? The answer is something most people have never heard of. And it's honestly kind of brilliant in a cynical way. Stablecoins. You know USDT, USDC, these digital tokens people use to trade crypto? Here's how they actually work. You give Tether or Circle $1. They give you one digital token. Seems simple, but here's the trick. What do they do with your dollar? They're legally required to hold reserves. And the easiest, safest reserve? US Treasury bonds. So you hand them real dollars, they hand you a digital IOU, and they take your cash and buy US government debt with it. It's genius. The Genius Act, which passed in late 2025, essentially made this the official strategy. You've got millions of people around the world who think they're just holding digital dollars for trading. What they're actually doing is funding America's debt. They're the new China, the new Japan, except they don't even know it. And they can't exactly freeze or weaponize their holdings because it's not a foreign government. It's just random people with Coinbase accounts. I read the SEC filings. Tether alone holds over $80 billion in US treasuries. Circle's got another $50 billion. And this is growing fast because crypto people love stablecoins. They think it's safer than volatile crypto. They don't realize they're the exit liquidity for the US government's debt problem. Now, here's the thing about inflation that most people miss. It's not random. It's not some natural disaster that just happens. It's a policy choice. And the choice has been made. Trump went on record saying he wants 20% GDP growth. 20% in a developed economy. That doesn't happen through productivity. That happens through inflation. You get 3% real growth, 17% inflation, you hit your 20% number. You look like a hero. The economy looks bigger. And the debt becomes easier to service because you're paying it back with devalued dollars. Let me give you a concrete example. Say the government owes $1 trillion today. If they can create 10% inflation for 7 years, that $1 trillion in real terms is now worth about $500 billion. The number on the page is still 1 trillion, but the actual economic burden is half. They didn't pay off the debt, they just made it way less. And who pays for this? Anyone holding cash. Anyone on a fixed salary that doesn't keep up. Anyone who believed the old rules about emergency funds and savings accounts. There's two economies in America right now. There's the Wall Street economy and the Main Street economy. And they're completely disconnected. Wall Street's hitting all-time highs. The S&P is up. Tech stocks are flying. Real estate in major cities is insane, but regular people are drowning. Groceries cost more. Rent's up. Gas is up. Their paychecks aren't keeping pace. And the gap is accelerating because the people who own assets are getting richer from inflation, and the people who rely on wages are getting poorer. This isn't a conspiracy. It's just incentives. Politicians want to get reelected, so they spend money on popular programs. They don't want to raise taxes because that's unpopular, so they borrow. The Fed wants to keep the economy humming, so they keep rates low. Wall Street wants cheap money to juice stock prices, so they lobby for loose policy. Everybody in the system has an incentive to keep the music playing, and the only way to keep it playing is to inflate the debt away. Now you're asking yourself, okay, if that's what's happening, how do I not get destroyed by this? Because here's the reality. Most people are going to lose, not because they're dumb, not because they didn't work hard, but because they didn't understand the game. They kept playing by the old rules while the rules changed. Let me tell you about a guy I know, 52 years old, worked in manufacturing his whole life. Good job. Union benefits. Did everything right. Maxed out his 401k for 30 years. Kept it conservative. Bonds, money market funds, some stable value funds. His advisor told him that's the safe play as you approach retirement. He's got about $800,000 saved up. Sounds good, right? Except his purchasing power is getting crushed. Let's do the math. If real inflation is 7% per year, which is conservative, his $800,000 loses $56,000 of purchasing power every single year. In 5 years, His nest egg is worth about $560,000 in today's dollars. He didn't spend it. He didn't lose it in a crash. It just evaporated because he was holding the wrong assets. Meanwhile, his neighbor, similar age, also in manufacturing, took a different path. He kept his 401k in stock index funds, bought a rental property in 2012 when prices were low, put 20% down, got a fixed rate mortgage at 3.5%. Fast forward to today, his stocks have compounded with inflation. His rental property appreciated from $250,000 to about $500,000. And his mortgage payment stayed the same while rents went up. That fixed rate mortgage at 3.5%, with 7% inflation, he's effectively borrowing money at a negative real rate. The bank is paying him to hold debt. His net worth is probably north of 1.2 million, and it's inflation protected. Same starting point, same income, completely different outcomes. The difference wasn't intelligence, it was asset allocation. Quick side note, if you're one of those people who thinks, well, I'll just wait for the crash and buy in cheap, let me tell you a secret the investment banks don't want you to know. Waiting for the perfect entry point is how you stay poor. I've been investing every single Monday for years. Doesn't matter what the market did last week. Every Monday, I move cash into assets. Because I know the one guarantee is that cash is losing value. Even if I buy at a local top, inflation will bail me out eventually. The people waiting on the sidelines for some massive crash, they've been waiting since 2010. They missed a 14-year bull run because they were too smart for their own good. And here's another thing nobody talks about. Let's say there is a crash. Stocks drop 30%. Great. You were sitting in cash waiting for this moment, but did your cash gain 30% in purchasing power? No. It lost value from inflation while you waited. So you're buying cheaper assets with devalued currency. You might not even come out ahead. The math doesn't work the way people think it does. So here's what I'm actually doing with my money. And I want to be very clear. I'm not a financial advisor. I'm not telling you what to do. I'm telling you what I do. And you can take it or leave it. Stocks are my core holding. About 60% of my portfolio. Not individual stocks, mostly. Index funds, boring stuff. VTI, VXUS, some sector ETFs in energy and healthcare. Why? Because companies can raise prices with inflation. Their revenues go up, their stock prices go up. I'm not betting on some genius stock pick. I'm betting on the entire system inflating. And if the system breaks, my stock portfolio is the least of my worries. Real estate is about 25%. I own my primary residence. No mortgage, which, yeah, in an inflationary environment, you could argue I should have kept the mortgage, but I sleep better without debt. I've got one rental property, fixed rate mortgage, positive cash flow, and I've got some exposure through REITs in my 401k for diversification. Real estate is the classic inflation hedge. As the dollar loses value, property prices go up, rents go up, your mortgage payment stays fixed. It's a beautiful setup if you can handle the maintenance headaches. Gold is about 10%. Half physical, half in an ETF. I'm not a gold bug. I don't think it's going to the moon. But central banks are buying more gold right now than at any point in the last 50 years. The people running the system are diversifying out of dollars. That tells me everything I need to know. Gold's not an investment. It's insurance against the system doing exactly what it's designed to do. And yeah, I've got some crypto. About 5%. Mostly Bitcoin, some Ethereum. I'm not a maximalist. I think Bitcoin was probably created by certain three-letter agencies to create a transparent ledger for tracking capital flows before they roll out central bank digital currencies. But you know what? I don't care. It's outperformed everything else in my portfolio over the last decade. And in an inflationary environment, scarce assets do well. There's only going to be 21 million Bitcoin. There's infinite dollars. Here's what I don't own. Long-term bonds. They're a guaranteed loss in this environment. You lock in a fixed rate, inflation runs hot, you lose purchasing power every year, cash beyond my emergency fund. I keep about 3 months of expenses liquid. Everything else goes into assets. And I don't own commodities directly. Except gold. Too volatile. Too much complexity. I'm a lazy investor. I want things I can buy and forget. Now, the mistake I see people make isn't what they own. It's the psychology. They panic sell when things drop. They chase whatever's hot. They think they can time the market. Let me tell you something I learned from sitting in rooms with accountants who manage money for people worth 8 and 9 figures. The wealthy are boring. They're not day trading. They're not chasing meme stocks. They set an allocation, they automate their investments, and they ignore the noise. That's it. Lazy investing built more fortune than crypto memes. I run my own business. I've got accountants, fiscal lawyers, people who actually understand tax code and asset protection. And every single one of them owns the same stuff. Index funds, real estate, some gold, maybe some munis for tax efficiency. They're not doing anything fancy. They're just consistent. They understand that in an inflationary environment, the goal isn't to get rich quick. It's to not get poor slowly. So here's what you actually do. Step 1, audit your portfolio. Write down what you own, how much is cash, how much is in assets. Be honest. If you've got $50,000 sitting in a savings account earning 1%, you're losing $4,000 to $6,000 a year in purchasing power. That's real money. Step 2, set a target allocation based on your risk tolerance. If you're young, you can be aggressive, mostly stocks, some real estate, some crypto. If you're older, you need more stability. But even at 60, you shouldn't be all bonds and cash. That's financial suicide in this environment. Step 3, automate. Set up recurring transfers every week, every month, whatever. Move money from cash into your target allocation. Don't think about it. Don't wait for the perfect moment. Just do it. And step 4, ignore the noise. Turn off CNBC. Stop checking your portfolio every day. The daily fluctuations don't matter. The long-term trend is clear. Currencies devalue. Assets inflate. Be on the right side. 3 final takeaways. 1, cash is not safety. It's guaranteed loss. The system is designed to transfer wealth from savers to asset owners. Don't be a saver. 2, boring wins. Index funds, rental properties, physical gold. This isn't sexy, but it works. The people getting rich from discipline, not from gambling. And 3, the reset is already happening. This isn't some future event. It's now. Every month you wait is a month you lose. Position yourself accordingly. The politicians know this. The bankers know this. The people who write the tax code know this. They're already positioned. They own assets. They benefit from inflation. And they're counting on you not figuring it out until it's too late. Don't give them that satisfaction.